Well, good afternoon, and welcome to another webinar in the regional webinar series put on by the Central California region of the Small Business Development Center. Good afternoon, I'm Kelly Bearden. I'm your moderator for today. I think we have a great webinar planned, and I think it's going to be a fantastic day for those wanting to get a great valuation of what their small business is and how you can figure out the value of the business. So before we begin, just a few housekeeping items just to get through. The Central California region of the Small Business Development Center covers 15 counties throughout the Central California region that largely encompasses the San Joaquin Valley, Eastern Sierra, and Central Coast regions. What do we do at the SBDC? Well, I'll get to that in a moment. But first, I want to give you some tips on interacting with today's webinar. Please excuse my voice a little bit under the weather today, which is, I guess, better than being over the weather, but that's another story. So please feel free today to use your question box. Your question box, if you notice in your dashboard on the right side of your screen, has a right arrow. If you click on that right arrow, it will open up that question box. Also, you'll notice that there is a box to chat, and the chat can be to communicate with organizers or others that are out there. So please use that chat. Also, please complete the survey at the end of our webinar today. We value your input, and we want to actually have that input for you. And to gauge the audience today, we will use polls. All you attendees are muted today, so if you do have a question, get back to the chat box and we'll try to, or the question box, and we'll answer all questions that we can at the end of the webinar. So what do? We provide high quality, no cost, confidential one-on-one consulting, training for a variety of small business owners on a variety of topics with in-depth classes, and we do special projects all throughout this 15 county region. And our administrator, the Maria Contreras Suite of the U.S. Small Business Administration, usually said of the U.S. Small Business Administration programs, of which they fund the SBDC program on a national basis, is it's the counseling that matters the most. So it's great getting that encouragement from her. So please take advantage of the counseling and the consulting. It's available to you. So, use that as an option for you. So at this time, I'm pleasure to introduce our presenter today. Our presenter is Peter Pappas, and Peter is an established expert in small business management. He's an adjunct professor of business and director of the Mitchell College Center for Entrepreneurship, providing education and consulting programs to small businesses. Prior to that, he was regional director of the Connecticut Small Business Development Center at the University of Michigan. Peter was trained as an engineer. He's designed and built manufacturing plants and retail centers in both the U.S. and Mexico. As an entrepreneur, he has held the chief executive officer of several closely held retail and service businesses, and is currently president of an advanced technology chemical process company and operates a private consulting business specializing in business finance and purchase. He has managed mergers and acquisitions of privately held businesses and transactions from $25,000 to $50 million. Holds an MBA from Northeastern University. Peter, thank you for joining us today and welcome.
Thank you, Kelly, and welcome to this seminar. Very wet southeastern Connecticut. It's been raining all day. It's going to rain for 7 days because not only do we have a storm system coming off of the Midwest, we've got a hurricane coming up the coast. I bet you wish you had the rain.
We'd love it.
And I would love to give it to you. So we're going to talk about valuation of a closely held business today, and as opposed to a public corporation, and I don't say small business because a closely held business can be quite large. It can be up to, according to the SBA definition, 500 employees. Now, the valuation of a public company is simple, right? Take the stock price based on an auction market, the New York Stock Exchange or NASDAQ or whatever, multiply shares outstanding, and that's the value of the business. No, not necessarily. It's the value of the business until there's a transaction. And you probably noticed that if an entity or a person wants to buy a publicly held company, there's a premium to be paid for control. We're going to talk about how the control premium affects closely held business. But typically, if a public company is underplay in a purchase situation, the purchaser pays 10 to 20% above the market value.
Peter, if I might just jump in a second.
Sure.
You'll click on the change presenters and my screen will go to yours. And in just a couple moments, we'll do a poll after this is done and we'll proceed on.
Okay, do you have my slide?
I don't personally, but...
Okay, I hope everybody else does. There are a lot of reasons why one would want to value a closely held business. There's just curiosity. More commonly, there's a purchase or sale of the business contemplated. We'll talk about how that happens. A partnership change. In the event that a partner is entering or leaving a business, the business needs to be valued to see what that partnership interest is worth, either in purchase or sale. This is a fractional interest as opposed to the purchase or sale of the entire. Succession planning. I hope I don't shock any of you, but you're not going to live forever. So if you own a business, eventually that business and you are going to part company, and it should be by plan. So the valuation of a business for that purpose can help produce a plan that's viable. After the owner dies, of course, there's an estate execution, and there could be legal action, divorce, partnership dispute, any number of disputes. I hope you don't have to be exposed to any of these, but being able to get a reasonable valuation of the business can help you if you're in that situation. Now, a business is valued as an investment and valued as any other investment. The valuation of investment is a capitalization of the return on the investment. In the case of these stocks, it would be the price earnings multiple. In the case of bonds, it's the yield multiple. And in the case of commercial real estate, it is the capitalization rate. All these capitalization rates are based on safety and certainty factors. This return stream is judged as far as certainty. Now that's looking forward. That's crystal balling, and that's what I'm going to help you do today. So the formula is the capitalization multiple by the current return. What is the business yielding right now? So therefore, a business with no income is worthless? Perhaps. We're going to get to that. And then there are some factors. Growth, the debt that is assumed by the buyer, and the assets. Simply an adjustment for the current assets that are going with the business. Sometimes current assets are stripped. The seller will take the cash, pay the debt, and offer the business clean. Sometimes the business is sold as an entity, and we'll get to that. Now, the valuation is irrelevant of asset cost or value. I had a client that came to me and wanted me to give a valuation on his gymnasium. And I looked at his return based on the capitalization multiple for that kind of business, and I told him your business is worth about $80,000. And he said, my exercise equipment is worth $100,000. And my answer was, sell the equipment. Your business is worth more dead than alive. The business value is a capitalization of its returns. In a lot of cases, it is wise to strip the business of its assets, sell the assets, and everybody goes home. Now, in the case of real estate, if it's tied to the business, there's a difference in the capitalization multiple. Businesses are usually capitalized, the big C up here, at a multiple of 2.5 to 4 times their return. Estate is usually valued at 8 to 10 times its net. Why? Businesses are less stable than real estate. If I'm collecting rent on a piece of commercial real estate, that is a lot more certain than the profit of the business sitting on it. So what is the capitalization rate? It's industry specific. It has to do with the stability and ease of continuity in a business. A painting contractor's productive assets get off the ladders every afternoon, get in their trucks, and go home. That business does not have the stability of, say, a waterfront marina with property that's very limited, waterfront property, that's at its highest, best use. The ease of continuity. Simply, can the customers be transferred? I have a consulting business. People come to me because they trust me. A beauty salon. The stylists have a loyal following. In the transfer of a beauty salon, the customers are more loyal to the stylist than the salon. Whereas in a product-based business, the customers are more loyal to the company because that's where the product comes from. We'll get into how this is done, but I use a simple rule of thumb. It's based on the assumption that there'll be full succession, and I'll talk to you about what that constitutes. Every business category has its own rules for a successful succession. For example, I do some medical practices. In a medical practice, the doctor needs to stay for a year. So every patient comes in and gets introduced to the new doctor by the old doctor, the trusted sawbones that they know, or those patients will not translate. They will not transfer to the new owner. A business such as a restaurant, it can be a little more transparent. The restaurant is open today just like it always has been, offering the same menu, we hope. A lot of times the buyer will make changes that affect that succession. Now, I use a guide called the Essential Guide, the Business Reference Guide by Tom West. Here's a picture of it, and forgive me, my slides are not going flipping as I would like them to. There are several guides such as this, but this is the one that I use. The counselor has access to it. Don't go out and buy it. As you can see, this is a 2013 version. I buy it every other year because it's $125, and I find it doesn't change that much. But if you go to your SBDC counselor, they have access to the latest. This will not only give you some rule of thumb valuations, but some guidelines as to the general average percents that the business has in terms of cost of goods sold, labor, profit, and it'll also give you some tips on how to successfully transition that business to a new owner. Now, all rules of thumb have limitations and advantages. This book is based on comps, comparable transactions, based on a national database, and there are others, and I'll tell you about some of the others. But businesses are unique. Every business has its own intangible market strengths and weaknesses. Now, a residential real estate agent will be able to give you a good idea of what your home is worth based on comparable sales, because there are so many similar homes being traded. In my town of 30,000 people, there are at least 20 residential single-family dwellings changing hands every week. And there's a commonality. They're all single-family dwellings. In many cases, it isn't hard to find a home so similar, built by the same builder in the same neighborhood with the same plans at the same time, that just sold. It's very valid for single-family dwellings. Businesses have their unique qualities as far as their market strength. What are their customers? What are their strengths in the market? This rule of thumb valuation will not hold up in court very well. If you're in the middle of litigation and you come in and say, well, I found this in the book, the opposing attorney is going to say, well, what experience do you have in business valuation? And where did you get this number? And it is not going to hold up as well as that 30-page professionally generated business valuation by somebody who's done it for 30 years. But it is a useful starting point. It is a great place to find a value and get a reality check, because in my experience, most sellers think their business is worth a lot more than it really is, and others think it's worth a lot less. At the end of the day, it's likely to be no less accurate than that 30-page detailed professional appraisal, because the first page of that appraisal is the disclaimer letter. I did this appraisal based on my 30 years of experience, based on these factors, ra-ta-ta-ta-ta, but it is not meant to be a bona fide valuation of the business, because only the market will set the true value in a purchase and sale transaction. I've been doing this for a long time. I've been doing rule of thumb valuations, detailed valuations, and I have to tell you, I have never seen the actual transaction settle within 20% of any valuation. There are so many factors, including the emotional factor of motivation. I've had sellers that had serious health issues that were very motivated to take anything they could get. I've had buyers that had dreams, sometimes valid, sometimes fantasy, that were willing to pay more than the value. So I'm not telling you that this whole presentation is worthless, but I'm telling you that you can get a starting point, but the market is going to set the value at the end of the day. Any valuation is based on assumptions, environmental assumptions. And they have to do with stability. Is the market stable? Can the customer loyalty be transferred? I told you about the beauty salon, that the stylist can literally take her customers home after the transition. In other businesses, customer loyalty is to the business. We have to assess that. If you are thinking of selling your business, think about how you're going to let go. Not of the business, of the customers. You probably know them very well. You have a relationship with them. Can you transition that? That's going to be critical on what value your business has in a purchase and sale. Is the competition stable? Have you continuously addressed it? Does the business address not only current competition, but emerging alternatives? and there are similar and dissimilar alternatives. Somebody who is in the business of doing oil changes may feel that their competition is other people that do oil changes. Maybe their competition is people developing oil that lasts 100,000 miles. So dissimilar alternatives may be on the horizon, and when you evaluate the competition, you have to do it creatively. And then there's town hall. Well, this includes all regulation. Most closely held business regulation is on the local level, but it could be state or federal. Is the business in compliance? Does it have a grandfather that's going to dissolve if the business is transferred? This business is in violation of current zoning, but we're going to let it slide until there's a transfer. And is the town or state going to build a bypass road that takes all the traffic away from the business? I recommend to anybody interested in the value of their business, purchase or sale of a business, visit town hall and find the economic development coordinator. Every town in every state has one, because economic development is a good thing for every municipality. It generates taxes and employment. They love it, and somebody is your advocate in town hall. Find that person and they will walk you through all the other regulators. The fire marshal may not want to give you the time of day, but if you are escorted in with the economic development coordinator, you're going to get an audience. There are internal assumptions in business valuation that have to do with stability. Is the equipment serviceable? Is it working? Is it production balanced? I worked with a corrugated board manufacturer. They had 3 corrugating machines feeding 1 cutting machine. They were out of balance. By adding a cutting machine, they balanced their production, increased their production, increased their value. This added a lot to the valuation of their business. Inventory. A lot of businesses, especially if they're established for a while, they carry a lot of inventory that may be damaged or obsolete. I worked with a bicycle retailer. He had over 100 used bikes up in his warehouse. He had a lot of space. It was a bicycle barn, and he wasn't paying for that space. And a used bike he just tucked in there. Why? Someday somebody may come in with the same bike and need a part. Did that inventory have value? Well, for that someday one-time need, but overall, really no. Is the merchandise appropriate to the business? A lot of businesses shift over the years to new markets and new products, yet their inventory could be the old products that are not going to sell anymore. Most buyers will not even see these internal things because the seller is not going to disclose it early on, but it'll arise during due diligence. I'll talk about what that means. Now, we talked about a growth factor. The valuation of the business is a capitalization multiple times the return plus growth. This is a wild card. It has to be a forward-looking thing with high expectation. If a buyer is optimistic, this is the wrong time to bid up a business, because what you think you can do, because contraction is more likely in transition because customers like consistency. I'll get more into that. An established business does not have a growth factor. It's already factored into the return. It's there. They're making the money every day based on what they're doing. However, a new business may be sheer growth. We've seen high-tech companies with a killer app that are attracting huge amounts of capital investment because of growth. They have no income. Their R in that C times R basic formula is 0. They should have a 0 valuation, but it's all growth. that is usually set by very professional, very savvy angel investors, specialized people who know what? They know the market. They know what people could buy from this business, even if the people don't even know they like that app yet. They can tell. Growth factor is pure speculation, but we can take it apart and say, okay, there's a patent that has value. There's a very favorable lease that has value. There's a zoning variance that has value. There is know-how. There is a culture that generates sales in and of itself because it's fun to do business with these people. It's hard to value these components, but we can inventory them. These days, the growth factor is a mix of intangibles. Intangibles are huge. 30 years ago, intangibles in the S&P 500 were minor. Hard assets represented 70% of the market value of the business. What was left over was called goodwill. Now it's a mixture of intangibles because now the hard asset value of the S&P 500 is probably of their market value. There are hard intangibles, meaning they're on paper. Leases, patents, permits, special privileges, and trade dress. Trade dress is simply the way that business appears, which is trademarkable, which is not copyable. If your business has a certain appearance, somebody would be infringing on trade dress if they copy it. There's soft intangibles, which are usually pretty valuable. Know-how, culture. The culture of a business can be very attractive to the market. A brand. For an established business, intangibles are already factored in the valuation. C times R, the R, which is the two most common are EBITDA, earnings before interest, taxes, dividends, and sellers' discretionary earnings. But for a new business, as I said, they could be the main source of value. It's all speculative at that point, and usually an SBDC counselor is not going to be as much help. What you need is to find somebody who is interested in investing. SBDC counselors will not show you a crystal ball. They don't have any. But they will give you very hard reality on business valuation. So by now, if you're a seller, you know that if you can increase the bottom line, you can increase the value of your business. The R in the basic C times R formula. So you refocus strategy to increase that bottom line, and that should require a business plan. That's an SBDC specialty. They do that every day. They do that very well. You can new markets or establish new established accounts that are going to continue to be businesses. You can expand your platform. Let me use the example of Uber. Everybody knows you can get a cab ride from Uber, but they could easily expand that same platform to deliver restaurant meals, to bring medical supplies to baby boomers who are going to need them more and more. So this is the time to think outside the box of the way we always did it. And let me tell you, if it ain't broke, don't fix it, is the war cry of the mediocre army. It is always worth improving. It's continuous improvement, not if it ain't broke, don't fix it. You can improve collections on accounts receivable, but that can be a wash. Remember, good accounts receivable are a cash equivalent. You're trading one cash equivalent for another. If you're selling your business, don't take on any new deals, especially contractual commitments like that 10-year commitment to advertise on the TV. Well, realistically, maybe a 1 year. Get rid of the problems. Settle the lawsuits, the claims, and the disputes. If you've got an employee with a workman's comp issue, if you've got a customer that got hurt, this is the time to get it out of the way, because it's going to probably impact the negotiation for your business more than it will cost you to get it out of the way. And this is the time to get rid of the deadwood. If you've been giving your brother-in-law a job for years to keep peace in the family and he's worthless, time to send him out. And write off bad debts. Write off bad inventory. It's going to come out eventually. Now, some sellers go too far with this. There are deceptive value-boosting things, such as deferring maintenance, cutting staff, reducing employee benefits. These work in the short term, but in the long term, the maintenance will have to be done, the staff is going to get disgruntled, and you'll have turnover. So a buyer should beware of radical changes in the policy of this business. If you get 3 years of financials and the last year looks fantastically different, something's changed. Is it a good thing? Is it a new market? Is it a reinvigoration of the business? Or is it one of these tricks? The seller can relax credit policy and book sales to a customer that they know is not going to pay. They could sell down inventory, impairing the business's long-term ability to fulfill sales. I've seen this trick. Book investment as sales. A retail business. I was working with the buyer. The seller maxed out her credit cards, put $25,000 in the business, booked it as sales. It wasn't sales. It looked like they had turned the corner. But if you look at the balance sheet and the income statement, you can see. And your SBDC counselor has seen a lot of financial statements. Let them help you go through this. And the owner can take less money out of the business. Let's face it, folks, a lot of owners of small, closely held businesses rape it, steal it every day. Let's not even consider whether it's legal or complies with the tax code. But the owner can make the business look better by just stopping the toting. So that you can use the book I told you about, Business Reference Guide, to get some industry standards. You should also look back a few years to see if there's a radical change in this business and why. A buyer of a business needs to get the right financial business data to evaluate the business. Remember, tax returns. Everybody says, I want to see the tax returns because people are less likely to lie to the government. Wrong. Tax returns are generated by professionals to pay the least amount of taxes. They can use the accrual effect to make radical changes in the bottom line and therefore the tax paid. A buyer should look at the accounting system, and I'll talk about due diligence and how that works. A buyer should be able to go to the accountant and say, what is the scope of your audit? Did you check these receivables and these payables? The answer is most likely to be no, because their customer, the seller, wasn't going to pay for a forensic audit every year. So that puts the burden on the buyer to go deeper into the books. At the end of the day, the tax returns and the books should reconcile. I had a case where an SBDC counselor had a furniture business and the tax returns showed half the sales as the books. That's a lot of accruals. It was impossible to reconcile. So you need to be able to reconcile these things through the normal accounting process. The R in the formula, C times R, the capitalization rate times the return, has many different ways to be measured. The book that I told you about, Business Reference Guide, we'll give you rules of thumb for several. There's the easy ones: profit, earnings before interest and taxes, earnings before interest, taxes, depreciation, and amortization. But in a closely held business, seller's discretionary income is the best and the highest of the three, because that's really what the buyer is getting. Seller's discretionary income includes all the seller benefits. Sometimes in a very common business, like a Burger King franchise, where they're cookie cutter, where they're formula driven, the sales are closely related to the bottom line, and there's a valuation based on sales. Not always, but common in a franchise. And the book I told you about does value franchises. Seller's disposable income, or discretionary income, is the entire benefit to the seller. Passive income, use of assets. Passive income: the seller charges the business rent. Rent is passive income. It's not subject to Social Security, workman's comp. It's not subject to unemployment. So it's good to turn income into passive income. It saves taxes. Very common. The seller may get benefits from the use of a company car or other assets. He may get totem privileges. Totem privileges: the owner of a restaurant takes home his groceries every night. There's a value to that. It's the company cost, not the market value, that is the SDE. It's the owner's compensation package. That's going to be transferred to the buyer. In order to qualify it as SDE, it must be completely unnecessary to the business but benefit to the owner. Forget the IRS rules, forget the accounting rules. It is what it is. For example, if an owner of a restaurant has a company car and just uses it to commute to work, there's no benefit to the company. That's absolutely a owner's perk. A painting contractor uses a truck to do work for the company. That's a productive business asset. That's not part of SDE. It has to be completely unnecessary for the business. In the balance sheet, SDE can hide anywhere. Cost of goods sold, labor, rent, any expense. And you business owners know who I'm talking about. Any expense can benefit the owner in some way. Let's do an example. Evaluation of a business. Here's their income statement. Let's assume this owner's salary and benefits has been proven out and we know what it is. That's their SDE. If we're going to do EBITDA, we're going to add up the profit plus interest, depreciation, and taxes, and we're going to get an EBITDA of $220,000 plus. For SDE, we're going to add the owner's benefit and get a little higher number. Now let's say this is a restaurant. We'll go to the rule of thumb and notice that EBITDA has a different multiple than SDE. I'm going to use the midpoint of both to figure EBITDA. In this example, EBITDA of $220,000 times 2.5, the middle point here, $550,000 SDE, $345,000 times the midpoint of this, $604,000. Are you getting already that this is not an exact science? I told you in the beginning, this is a good starting point, but the final value of the business is what it will sell for in a real transaction. Now, notice that in a restaurant, it's SDE plus inventory because inventory is a cash equivalent in a restaurant if it's sellable food. I mean, some restaurants, I'm afraid to tell you, they have some old stuff that won't sell. But here's an example of something you need to know for a specific business. Inventory in a restaurant is going to change every day. Typically, they get deliveries several times a week. It will go up at a delivery. Therefore, the value of the business will go up, cash equivalent. But inventory isn't booked till the invoice comes in. So the moral is the inventory has to be taken at the closing to really get the value of the business. Remember, it's a cash equivalent, and that assumes that it's paid for. Remember, inventory minus accounts payable comes out to zero unless it's paid for. This is all something a SBDC counselor can help you understand. Now, I talked about real estate being a possible complication. People often say, well, the real estate is worth X, so my business must be worth more. If the real estate is not engaged in the business at the highest best value, sell the real estate, close the business. You can say, I'm going to buy this business, sell the real estate. Well, that's going to affect the ROI stream. This is a rare thing. Rent is not a wash. I told you a lot of owners pay themselves rent. That's taking money out of one pocket and another. It should equalize, but it doesn't, because real estate capitalization rates are generally higher than business capitalization rates. So let's look at carving out the real estate. The example I gave you before, let's change it. That restaurant now pays $54,000 a year of rent to the owner. Separate entity. He probably owns the real estate in an LLC or personal. And here are his expenses and his net. His net income, $20,784. The cap rate for real estate is 9%. We get a valuation of the real estate, $230,933. The cap rate, I recommend you go to a commercial lender and ask him, what is the cap rate for this kind of real estate in this area? And he'll be glad to tell you. Sometimes he will express it as a multiple instead of a percent. So let's say the restaurant in the previous example pays that $54,000 of rent. So we revalue the restaurant with the SDE and the EBITDA lower by that $54,000, and we get an EBITDA of $450,000, value based on EBITDA of $415,000, SDE of $509,000. Remember, it's not exact, folks. The only value that counts is what's on the purchase and sale contract. So look at the difference, and I apologize, my slides are not progressing, but in the first example, the restaurant paid, and we showed the example before with the value based on EBITDA of $550,000 on SD of $604,000. Now the restaurant pays rent, it impairs the EBITDA and SDE, so they're lower, but the real estate is worth something that's at a higher multiple, which gives a valuation difference of plus $116,000 if the restaurant pays rent. Now, this valuation of the real estate is not an appraisal. It is the value of the real estate engaged in the business. If the real estate is worth more at fair market value, it should be uncoupled from the business and sold separately. There are alternatives: uncouple the real estate, close the business, sell the real estate, or not. Let me tell you, every business transfer, every purchase and sale has a huge emotional consideration. can the buyer let go? Is the buyer willing to take less money to see his legacy and his name on the sign live on? It happens, folks. There's a huge emotional consideration, a huge emotional component in the valuation. And the rule of thumb doesn't begin to address that. Motivated sellers, motivated buyers, I've seen them all. That's why this valuation exercise is only a starting point. There are alternatives to this return on income approach. Comparable sales, well, my book is Comparable Sales, not my book, but the book I use. Based on a database, I talked to you about how it works really well with residential real estate because the commonality, but it doesn't work that well in commercial situations because businesses are unique. They have unique service areas, unique market strengths. Another database is on Biz Buy Sell. They have got 750,000 actual transactions under their belt. Your SBDC counselor has access to that. But remember, at the end of the day, every business is as unique as your fingerprint. They have their strengths, they have intellectual property. And market conditions, we all have lived through several gyrations in the market, even including that residential real estate. There are other valuations that are available to you. The assessor may have a valuation. It's based on cost. It's not a good valuation, but it is a published piece of data that you need to address if you're selling your business. Book value, the net value of the assets over the liabilities. I've seen this work in estate cases where the owner transfers a fractional interest, 0.5% to his kids every year and uses book value. It's so inconsequential in the estate settlement that I've seen auditors say, okay, we'll let that go. Replacement value. If you're doing rental property, if you're considering buying an apartment complex, thinking about what it would cost you to build one across the street is a good comparison. And always, a buyer should always say to himself or ask for help, rather than buy this business, what would it cost me to open up and compete? If you think you're that good, maybe that's an alternative. And that goes back to the business plan. Do a business plan both ways with your SBDC counselor. You should be aware of discounts and premiums. You get a discount for lack of control. A minority interest, a fractional partnership is worth a lot less because it doesn't have control. Marketability, there may be contractual buy-sell agreements that restrict the transfer of that asset. Trapped in capital gains, there may be capital appreciation in the business that taxes would be due on a transfer. I'm not going to go into details because we're running low on time, but usually this happens especially in divorce cases where the house is worth a lot more than the asset value in the settlement, and whoever has the house is going to pay capital gains when it's finally sold. Key person. You may have a rainmaker in that company. If they leave, that company is impaired. That calls for discount in the valuation. Premiums, control. I told you in the beginning, a publicly held company usually sells for up to 20% more than its stock market value to get control. Competitive advantage. A company could have something that distinguishes it in the marketplace. Could be a short-term thing. In high tech, it could last a year. In manufacturing, it could last 20. But there are premiums for competitive advantage. I'm I'm throwing these in not to confuse, but to make you aware that evaluation has to be considered in terms of the whole of the business ability. There are professional appraisers, an accountant accredited in business valuation. Don't use the accountant that's worked with the business, get a referral. You can go to the SBA website and find nationally accredited appraisers. There are people who just appraise fishing vessels if you're on the coast, and I assume you all are close to it. Bear in mind that the appraisal of the vessel is probably going to be less than the license. I'm going to go through this really quick because Kelly's going to tell me I'm out of time momentarily, but if you want me to come back and go through the whole buy-sell process after valuation, this is it. The seller makes a conscious choice to sell the business. The seller packages and markets the business with a seller some vital information but not anything confidential. Based on that, the buyer does an initial evaluation, submits a conditional offer. It should be based on things such as there are no debts in excess of X. There are no outstanding lawsuits or judgments. The buyer has the legal right to sell the business. You'd be surprised. Then there's negotiation and acceptance. Due diligence is a process where the buyer is allowed, under a confidentiality agreement, to examine the books, the assets, everything. That's when the obsolete inventory is revealed. That's when the unbalanced production equipment is revealed. And then based on any findings that deplete the value of the business, there's a final negotiation. A purchase and sale agreement is generated by an attorney qualified as such. And then transition, which is huge but neglected. The owner has to transfer the customers for the maximum value to be achieved, and the owner has to agree not to compete. A non-compete should be part of every purchase and sale agreement. So that's my presentation on business valuation. I think we're coming up to 0 hour, so I'll ask Kelly to step in and moderate.
Well, it looks like we're about out of time. I would like to encourage everyone to please fill out the survey. Let us know about the program. Let us know if you're interested. We could have Mr. Peter Pappas back and do one in a little more comprehensive on either buying or selling if you're interested in that, or other topics that you'd like to hear on the webinar series. Please put that in your survey. And also, if you would like a copy of the handouts emailed to you, we can actually do that if you leave your email address in that survey. So we'll be back next month with another webinar. Until then, time is up. And for Peter Pappas, I'm Kelly Bearden. Have a great afternoon. Thank you.